Hello, I'm Liz Lumley of Finextra, and today I'm speaking to Michael Davison and Kieran Colville, both of IBM.
Hello there. Good morning.
So we're going to have a little bit of a discussion about the UK's favorite topic, which is mortgages. And so, Michael, we had a bit of a discussion before we stepped in the studio, and you talked a little bit about how the mortgage market in the UK seems to be positioned for a large amount of growth.
Yeah.
And I just wanted to maybe ask you, why you think that? Why now for this industry?
Well, if you look back over the last 72 months, we've had a period of deep retrenchment in the UK mortgage industry and indeed in the Republic of Ireland, where mortgage market demand, particularly from first-time buyers, effectively collapsed. And the level of activity that was seen was really servicing existing books. Mm-hmm. And activity in the mortgage industry was very much on working with government and regulators to make sure that arrears and repossessions were kept to an absolute minimum. So we've seen remarkably a rapid uptick in the mortgage industry as the macroeconomic indicators start to look good. In fact, it was back in September, the Governor of the Bank of England, Governor Carney, made a speech in which he said that he was started to be concerned that some of those indicators mean that the mortgage industry is starting to grow perhaps a little too quickly, and made it very clear that he would be ready to intervene in very specific ways and recommend that certain lending restrictions were made. So it's a good time to be thinking about growth, but it also means that there are a number of challenges around people.
So, Michael, you mentioned people. But where do you get this idea that human capital is at least important for growth as the financial resources?
We know that many businesses, many mortgage lenders actually packed up shop, particularly the specialists, withdrew their products from sale and went home. And it follows that some of those people who are mortgage recommenders and sellers, they went with them. So it's only now, after that long period of time, that we're seeing quite a rapid uptick in demand. And we now know that there is a great deal of demand up and down the land for mortgage advisors. So much, so obvious. I think what's different this time is there's been a very searching mortgage market review between government and the industry, which has made some very tough recommendations about who is fit and proper to be a mortgage advisor and what standards of proof must they be able to demonstrate. So these are not just any old salesperson, these are professional advisors advising and recommending on what are essentially, apart from pensions, the longest term contract that you or I will ever make.
So, Michael, you touched on a little bit about talent acquisition in the mortgage market. So, moving on to you, Kieran, what are some of the sort of challenges and barriers with sort of acquiring this talent for mortgage departments?
Yeah, I think that it's an interesting time for the mortgage industry. As Michael said, we've got increased demand within the marketplace, and organisations and businesses needing to recruit new talent in terms of growing their book of business. And I think there are three opportunities for the mortgage industry at this time in relation to that. Number one is around measuring the right characteristics. If you think where the mortgage industry has been over the last few years, from a very liberalised environment, one where the risk appetite was higher, greater levels of innovation and arguably more aggressive sales targets, to one where we now have more prudent growth with a stronger focus on the customer and responsible lending. The types of people that will succeed in this new environment may be different in some respects to the ones that succeeded in the previous environment. And we've done some work focusing particularly at some critical job families within this industry. One would be branch managers, and the other would be team leaders in call centre environments. And what we've been trying to understand is, based upon the new set of metrics and performance outcomes that organisations are looking to achieve, things like net promoter scores, much stronger focus on customer outcomes, what type of characteristics, both learnt, like behaviours, but also hardwired, the things that you bring about you in terms of personality and motivation, what things in these critical roles within the mortgage industry will actually lend themselves to success in this new environment. Mm-hmm. So within this higher levels of regulation, higher levels of compliance, what does a great branch manager look like? What does a great team leader look like? And how can we replicate this within all of the people processes in the organisation? So everything from how you attract, to how you recruit, to performance management and learning. How can we actually understand these characteristics and make sure that through all of these different people processes, we're actually replicating success? So that would be the first area, really measuring the right stuff, the right characteristics through all of the processes that you're going to put in place. The second is actually focusing on what we call the enablers for performance. And where we're working with a lot of companies at the moment in this space is by understanding how employees feel in relation to their levels of engagement and things such as customer satisfaction and service levels, the skills and tools to do the job. We're able to understand how they're feeling today, predict for likely outcomes for the business in the future in terms of the likely impact on performance, and help companies take action now that delivers improved performance outcomes down the line. The third area is around using technology as an enabler. So in any war for talent, when we're looking for new sellers, for example, mortgage advisors, rather than organisations waiting for talent to come to them, being more proactive in engaging that talent in the marketplace, possibly people who might even be passive today, not actively looking, using links to social websites, for example, and social media, using recruitment and onboarding technology to actually engage people through the process of recruitment, make sure that when they land in role, they're productive, they tick all the boxes from a compliance and a regulatory standpoint, and they're fully engaged and understand the values and what it means to work in this business.
You mentioned a little bit about measurement and metrics, and I wanted to maybe go into a little bit more detail on that. I mean, are there any sort of measurable people risks inherent in the processes you described?
Yeah, I think there are several. I mean, there are some generic to all organisations, but if we focus in on where the mortgage industry is right now, I think there are two areas that, from a measurement standpoint, I think the industry has an opportunity to leverage. The number one is around conduct risk. And obviously conduct risk is something that's very prevalent in the financial services industry as a whole at the moment. And what we've been able to do working with some ex-regulators is to help, from a people perspective, define conduct risk, to help measure for it and predict for it. So essentially the question we're trying to answer is how can we help predict for potential conduct violations? So we capture them early. We don't actually let the violation happen and the outcome be poor for the customer. How can we predict for it and prevent it? And what we've been able to do is focus on three areas. One is around the skill of employees. So using things such as learning data, competency data, but also how employees feel in relation to the skills they have to do the job. Do I feel like I've got the tools to be effective in my role? If we're able to measure those things early, we can actually predict for potential skill lapses that might lead to a poor customer outcome down the line. The second area is what we call will. Essentially, do I care enough to worry about the customer outcome? You're not acting against the customer outcome, but if there's a violation or you see some misconduct happening, do you care enough to whistleblow, to actually call it up and make sure that something's being done about it? And so this is in relation to things such as employee engagement. Do I have pride and satisfaction in my job? Am I connected to the company in the right way? And if we can, again, measure that stuff through things like employee surveys, we can predict for likely outcomes down the line. So whether people feel more engaged or less engaged, we're likely to see more or less likely conduct violations, because people are caring more, they're more likely to do the right thing and call things out. The final area would be what we would call misconduct. So whereas the first two, people aren't acting actively against the values of the organisation and against the values of the customer, the third one is people are, either to act in their own self-interest or because they want to short-circuit a process, actually bypass a set of compliance to do things quicker. And again, we can predict for the likelihood of people undertaking misconduct through things such as assessments, but also giving employees the opportunity to identify these things early using platforms such as social to allow people to give feedback on things they're seeing in the organisation, being able to aggregate that data and help organisations understand the potential risks in the organisation. So there's a lot of data and measurement that you can do focusing on the skill of employees, the will of employees, and the potential misconduct of employees as well. The second, which is I can sort of summarise in more briefly for you, is really around the quality of the senior management in these organisations. Obviously what we've got now is a highly complex regulatory environment. You've got various different bodies, the UK government, Basel, the FCA, the PRA, all these different bodies who are providing a level of complexity for senior leaders in their decision-making processes. So what we're doing is helping organisations understand, what is it about these senior leaders that you need in order for them to be effective to actually predict these future outcomes? How can they decipher all of these various market trends that are happening, understand all the competing noise that might be in the market, and how can they form a strategy effectively? And you can measure particular components of senior leaders, both their hardwired traits, but also their behaviours as well, to actually understand the likelihood of them succeeding in these more complex roles at the top of these mortgage businesses. So that's another strand there that we would look at really from a senior leader perspective. It's important that these mortgage businesses are getting right because the complexity has increased in terms of the regulatory environment.
So, Michael, I'm going to end the conversation with you. I mean, no one in the industry really wants to repeat some of the mistakes of the last housing bubble in the UK. But, you know, where does the industry go from here? Where's the balance between continuing to lend and being prudent?
I think there are a whole range, as Kieran suggested, a whole range of different currents and countercurrents that the industry is having to deal with. On the one hand, the government is encouraging through various schemes, making it easier for people to start to get on the housing ladder, which is a bigger discussion, which we'll leave on one side. Some would say the timing is good, others would have a different view. On the other hand, we have regulators who are very intensely scrutinising the industry and saying, well, we need to be careful that we don't overdo this. So I think mortgage lenders will be lending very thoughtfully and very carefully. And I don't anticipate that we'll see any repetition, as you say, with runaway volumes of new mortgage lending anytime soon. That said, the prospects for the industry are great. There's a lot of pent-up demand, and the housing industry itself is starting to kick in once more. So the prospects are good. We only expect to see a return to what might be called prudent quality lending over the next period. And I recall the managing director of the Yorkshire Building Society on the BBC only a couple of weeks ago talking about just that. We're getting back to basics. This is about helping people buy a home. This is the longest term contract that many, if not most, will take out. And it's about helping them to do that. So it's a responsible industry. It's an industry which will recover its poise. And it's an industry which will work very closely, I think, on a continuous basis with government and regulators.
Excellent. So, Michael, Kieran, thank you very much.
Thanks.
Thank you very much.